Three Fed officials just voted to raise rates, and they lost. Here's why that fight matters for your wallet. The Fed held the Fed funds rate steady this week at 3.5% to 3.75%. That rate doesn't affect your mortgage rate directly, but it shapes the whole borrowing environment, so it definitely matters. Now, here is the part most people missed. The vote was not unanimous. Three officials wanted a quarter-point hike, worried that Middle East tensions and rising energy prices could keep inflation stuck. But the majority held. And why hold? Because the Fed is walking a tightrope. They want inflation back to 2%, but they also don't want to crush a job market that's already cooling off. And the inflation news helped their case. PCE, the Fed's favorite measure of inflation, cooled off in June, with annual inflation easing to 3.7%. Core PCE, which strips out food and energy out of that number, eased to 3.3%. Lower energy prices did most of the work. Now, for housing, and this is for you buyers and agents, prices are still climbing. Case-Shiller showed home values up 0.6% from April to May, and the FHFA Index showed prices up 0.8% in May. Now, waiting for a crash is a losing bet, guys. One more note. Second quarter GDP grew at 1.5%, which was softer than expected. So the economy is slowing but not stalling out. So what does this mean for you? Rates are stable, prices are firm, and the buyers who move now are probably not stuck in a bidding war. Whether you're buying a home or financing a commercial deal, I do both, residential and commercial, and I'm here to help. And I'll see you next week for another update.